is great because it's really education helping traders, and we can never learn enough. Casey, I'd like to thank him as well because I think he made a lot of great points. And actually, he talked first about preparation. I couldn't agree more. I think you have to be prepared. I think also being prepared helps make you adaptable. Now, we're going to test that theory because I was very prepared for this presentation, but I'm going to change it up a little bit, actually based on what Casey presented, because I agree. I was traded Forex a long time, particularly the part about increasing your risk is a bad thing. Increasing your profit is good. Now, with that, we talk a lot about stops in trading. The way I'm going to change this presentation up, I was going to kind of go through some of the basics, but a lot of you have seen the overall presentation of the bull spreads that we talk about and defined risk trading. I'm going to actually ask a question here. What if you could move your stops actually farther away, but take less risk? That'd probably be pretty neat. Sounds counterintuitive, but that's actually what I want to focus on today. I want to build on what Casey was talking about, because that is, particularly for the newer trader, that is the bane of their existence. I was a trading coach for a few years, worked with a lot of people on it, and we'd see either stops way too tight or way too far away. So let's take a look at how we do some defined risk trading and how we can use it actually as a combination. Now, the first two bullet points there, if you're new, if you haven't seen the NADEX contract, the bull spreads, I really kind of hate that name because you can be long or short. I'm just going to touch on them briefly. I recognize a lot of the names in here, and so I know you've seen some of this presentation, so I don't want to bore you with that. If you are new to the bull spreads, though, just try to hang with us. Morgan's got a lot of great content on the site on Trading Pub, and so I don't want to spend a lot of time because I really want to get into the theme and carry on with the theme that Casey had. So let's see here. Quick risk disclosure. Trading's not suitable for everyone. Definitely not. You know, anytime you put money in the market, you can lose it. With NADEX, you can't flip upside down, but you can lose everything in your account. So, you know, take care of your risk, and that's what we're going to talk about today. Just real brief, because I know a lot of people may or may not be familiar with NADEX. We are an actual exchange. So we're a DCM, the same as the Chicago Mercantile Exchange, the same as ICE, registered with the CFTC. Where we're unique is we're actually the only exchange where the retail trader can actually come in and trade directly with the exchange. So currently they don't need to go through a broker. All of our contracts also are designed specifically, I think, for probably a lot of people on this presentation. Low cost of entry, all limited risk, and it's really the only U.S. exchange that accepts direct retail members. Located in Chicago, as an exchange, we're not there to take the other side of your trade. We simply match buyers and sellers. We have to be unbiased. So real quick, like I said, I'm going to kind of take this first part really quick. Not to confuse anybody, but I just really want to get to the meat of the presentation in the time that we have. So again, if you're not familiar with the bull spreads, or it seems like I'm rushing through this, go back afterwards. You can definitely find a lot of information where we take a lot more time. Also, I like to get to the charts right away. I see a question there. How is NADEX related to IG Index? IG Group out of London is actually the parent company of NADEX. I'll talk a little bit more about who can and who cannot trade NADEX, as well as some developments at the end here, which are really, I think, going to open it up to basically the entire world, which will be applicable. I saw Morgan's map, so we're going to take a look at that too. Basically, a spread is a simple short-term contract. There's daily and there's intradays. Limited risk. Every contract that NADEX has is limited risk, meaning you know what you're getting into when you're walking in. There's no slippage, there's no gaps. World War III could break out, and when I get into that trade, I know what my maximum exposure is. If you've traded options before, it's similar to I say vertical call spread there. It's actually a vertical spread. It could be a put spread, could be a call spread. There's a floor and a ceiling. Now what we're going to do is use that limited risk aspect to manage, of course, our risk. You can trade them long or short, and again, they're priced for the retail trader. So let's actually get into what one looks like. This is actually just an old chart of oil. I'm sure some of you on here have seen this before. But we've got oil right here trading about 75. Now, if I wanted to place an order on oil, one contract of oil, I wanted to buy it at 75. I place my buy order there on the screen, and then I'd put in my stop. Now, $1 on a full contract of oil, is going to be $1,000. So I've got $1,000 stop, and I'm going to try to increase my audio here a little bit because I'm seeing some people come across, and let me know if that's getting better, too loud. Um, so we've got basically in this scenario $1,000 stop. So we've got oil trading right over here. Over you can see my cursor right around the 75. I place the trade, and sometimes I get stopped out. I think you can actually increase the chart size as well. Looks like some people are having trouble seeing the chart, so I think you can click the upper right, but maybe Morgan can help out with that. Um, with this chart, right, we bought at 75. We just got stopped out. We lost $1,000. That happens. Sometimes we make 1,000, sometimes we lose 500. That's trading. And oftentimes, as Casey described this scenario, what about a shakeout? All of a sudden, the market hits our stop, but then kicks back, and what do you know? We would have made money, but we got stopped out. Too bad, boohoo for us. We take our lumps and live with it. Hopefully, we are profitable the next time. So let's take a look at maybe a different way to trade this, and this will just give us an introduction. We've still got oil at 75. With a bull spread, though, we actually have a floor at 75. We make multiple ranges with the bull spread. So we make multiple ranges on each underlying market every day, and it's a floor or ceiling. So I might have a bull spread that goes from 75 down to 70, one that goes from 75 to 80, or maybe even smaller ones. In this case, I've got a floor at 75 and an expiration time. These are effectively options. I call them options for non-options traders. They're maybe a little bit easier to understand, but they have kind of the benefits of options from a risk protection standpoint. So if we're looking to buy, we've got our expiration time. We're also, by the way, going to take a look. These are short-term options, but again, following along the theme, the last example I want to do kind of shows how we can take a swing trade and use a short-term option to do kind of a combination. So in this case, oil's trading about 75, maybe 75.05. We're going to be buying the bull spread at 75.25. Why would we give up 25 ticks risk? Well, optionality. It's an option premium. Whenever we're trading close to the floor or ceiling, we're going to pay a little bit of premium. If there's more volatility in the market, we'll pay a little bit more. Our risk is limited as well as because there's a range, so is our profitability. In this case, we've got a range of $75 to $80. $1 per tick. So in this case, there's 500 ticks. So I've got 25 ticks risk. I've got a potential upside of 475. I see a question there on the euro. Actually, I'll make an announcement about something coming up on the currencies in just a little bit, which I think should be exciting for everybody. So in this scenario now, this happens. The same thing that happened in our regular trade. By the way, on the first oil trade, we had $1,000 risk, and we'd probably put up, not counting intraday margin, because everybody does that a little bit different, $6,800 roughly in margin. I could get into this trade on a bull spread. I'm giving up a little bit of edge or optionality to the market, but if I trade 10 contracts, which is a per point equivalent, I've got $250 risk on this trade. Also, because it's an option, I don't have a stop. So if the market does this, well, I never got stopped out. I had a chance to make money. Again, because it's an option, I'm protected by that floor or ceiling. That's why I'm willing to give up a little bit of optionality. We'll get more into these examples in a little bit. Let's look at another scenario. Okay, all of a sudden the market moves up in our favor. Shoots up. Obviously these are hypothetical because I'm showing you the same chart that goes in several different directions. In this case, if it runs past 80, well, the highest, if it goes to expiration over 80, the most we can make is 475. That's our upper boundary. Opposite on the short. If I'm short, wherever I have wherever I'm selling, the difference between where I'm selling and the ceiling is my risk. Difference between where I'm selling and the floor is my profit. And again, I'm running through this part really kind of quick. So if I'm losing a few people, just hang with me because I think as we get into the examples, it'll make a little bit more sense. Or we have a scenario like this. So we showed it going down. If it drops below 75 and stays down there, um, well, then we lost our 250 bucks as opposed to losing 1,000. And John, the difference between a bull and bear spreads, again, the term bull spread, don't let that fool you. You can be bullish or bearish on these. I actually prefer the term, you've probably heard Daryl Martin from Apex use it, box spreads, because they look like a box on the chart. But in this case, okay, we got in at 75.25. The market moved. If we just let it go to expiration and it settles at 77, well, then we made 175 on 25 per contract. We can also set limits to trade anywhere out there. It's going to settle to the underlying market. Yeah, you can always add contracts to your current trade up to expiration. Now, if you're trying to do it 30 seconds before expiration, there's probably no point because you've got really um, really very little upside unless there's a huge move. But yes, you can sell anywhere up. If you're long, you can sell anywhere before expiration. You can set limits to do that. You can try to do it manually. If you if you're short, you can buy it back anytime up to expiration. So let's get in. This is just kind of an overlay of the actual how they're structured. We have multiple daily contracts. So these are available on currencies, major currency pairs, and some yen crosses. Um, Commodities like oil, gold, silver, copper, natty gas. Um, Actually, these are totally different than the binary options. Binaries are typically a fixed payout. Binaries are a fixed payout at expiration. These are going to be a variable payout because it can settle everywhere. So we're going to have multiple ranges. So if we take a look at this, there's going to be ranges made around the market. So we've got a big daily. In some cases, we have multiple daily ranges, depending on the market. As we get into like the 8-hour contracts, as you see here in blue, there's going to be multiple floors and ceilings throughout the day, as well as ranges around it on a shorter time frame. Now this is going to be important because I would typically look at these to trade near a floor or ceiling because the whole premise here is limiting risk. Let me go back here one slide. So as we can see, we had new ranges made. And yeah, I'll actually get into the demo accounts in a little bit. I think Morgan will put up a link as well in a little bit as we get towards the end. But yeah, demo accounts are available, and we'll even go over how you can get one with your live account. So I definitely encourage that. By the way, um, don't worry about the complexity. It actually becomes very easy once you get used to it. But again, I'm going to encourage everybody to do it in the demo account first. But once you kind of get the concept down, I think it'll become clear when we get into the additional examples. So as we can see, when the new ranges came out, they tracked the market. So this is going to be pretty important because we're going to be looking at floors and ceilings, again, to limit our risk. And what we're going to take a look at is how we can use these in conjunction, whether we're trading Forex or futures on stock index, so like the ES. If we're trading that, we're going to take a look at an example in just a little bit on how we can use these together. But this is actually a currency one, and this is going to go along with Casey's point on limiting the risk. So let's say we've got our market here. We've got the Euro USD. Let's say we were going to get long at 131.35. We decide where we're going to place our stop. Maybe we had that, I think what Casey called the safe stop. Now, for me trading, that would have been way too far. That's way too much risk on a contract. If I'm long one, I agreed with Casey. I wanted to be tighter on the market. I wanted to be patient. Um, some people I've seen use those bigger stops. What I want to do is actually use the biggest stop possible, but take the least risk possible. Kind of the best of both worlds. So this is the position in the underlying. We're going to be long, let's say one contract, Euro USD at 131.35, 125 pip stop. So 1250 risk on the Euro USD on one contract. This is the Euro USD. So we can take a look, and maybe, we've got then some different areas we could have moved our stop up. But maybe we've got this position coming on, and so we're on this position, 131.35, we're long. I'm long the underlying. I can now look to NADEX to see how I can limit my risk. Basically, I want to buy insurance, which is one of the beauties of options. So we've got the Euro USD. As we mentioned, we've got multiple spread ranges each day. So on this particular day, I actually had, this was one a client set to me. I like to use real, I actually like to use real examples that clients send in. And so we've got a spread ceiling at 131.50. So because we're long the underlying, we're going to go short the spread. and we'll see how that works. We've got basically a 250 pip range. Hopefully that yellow shows up on everybody's screen. That's the width of the spread. So 250 pips. So it's a pretty good size range. If the underlying market's at 131.35, again, I'm going to pay a little bit of optionality. I'm not going to be trading right on the market. I'm going to basically pay that little bit of premium in options. And again, that can vary depending on the time, how much time is left in the option. This is actually great because it looks like you're trading the underlying market. You don't have to run all your calculations. You can determine by your plan. So here we've got our initial stop of 125 pips. Now we're going to go in and we're going to sell 10 NADEX spread contracts on the Euro USD. The reason we're going to sell 10 is to make it equivalent to our position in the underlying. So example, one standard contract on Euro USD is $10 per pip. The NADEX spread contract is $1 basically per pip. So in order to equal those out, we're going to sell 10. Now our risk on the actual spread, just the spread itself, is 25 pips or $25 per. Binary options are available on NADEX, and Ron, actually I think depending on the binaries you're looking at, because there are a lot of scams out there, NADEX as a regulated exchange is quite a bit different than what you've seen on most. And I do think binaries definitely have their place. This contract is a little bit different, though. I think as an underlying trader, this is actually one of my favorite strategies because what I was looking for the entire time I was trading was a way to limit my risk on my entry particularly. So now if I look at my risk, though, technically I've only got 10 pips risk. We're going to see why that happens. So because if I'm short the spread at 131.25, if it goes up, which is what I'm hoping to do because I'm long the underlying market, I want the market to go up. But in case I'm wrong, I want to limit this. Right now, I've just sold my spread at 131.25. I've got protection down to 129.00. So what that means is I can do is now I can move my stop down to 129.00. Here's the great thing. What I mentioned, what if you could move your stop farther away but actually take less risk? When I was just trading the straight underlying Euro USD and I had 125 pip stop, I had $1,250 of risk on that one contract. I've now got effectively the same trade. We'll talk about the nuances here in a second. I've got the same trade on, but I've got protection down to 129.00. My risk has now gone from $1,250 to $100. Because my risk, the only part I can lose, is that red part you see on the screen, the 10 pips. And that's really one of the magics of it. What if I could take my risk, and also the shakeout? What if it shakes out? So what if the market does something like this? Well, on the underlying, let's say that's trading now around 130 at this point. So it's down 135 pips. Pip in this case equals $10 on a standard contract, $1 on a mini. So here we've lost in the underlying contract from 135, we'll say it's right at 130 even. I realize that's probably hard to say. Let's say the underlying contract lost 135 pips. That's $1,350. We'd have been stopped out probably earlier than that anyway if we were just doing that. In this case, though, the spread, because I put it on, I'm still in the trade. I've actually lost 10 pips instead of 135. The upside, what if the market goes in our favor? Because this is really what we want. I like trading the underlying markets because I have unlimited profit potential. The problem is it can get kind of risky, as we saw in the other one. The shakeouts, terms like stop hunting. Now I was able to move my stop farther away. So now, because I traded the spread, once I hit 131.50, my spread is effectively off. So from 131.50, now I'm making money. Now it can run for 200 pips in my favor. All of the risk, really, on any trade, I don't care whether it's a short-term trade or if it's a swing trade, should be up front. And what I mean is it's on your entry. We're going to take a look at a swing trade example, and I'll show you exactly what I mean by that. With regard to a question of a pip, think of it like a tick in the underlying market. Mike, why aren't we buying the spread? If we were using the spread just by itself, we actually could have bought the spread. And I'll take a look at that example in just a little bit instead of doing the combination. And yeah, we're going to talk about intraday and swing trading. And John, definitely it's a unique concept. That's why I definitely recommend a demo account first to really get in. Morgan's got a lot of great information. I kind of want to go over the basic concept, which is going to be kind of difficult, I think, particularly if this is the first exposure for a lot of people to comprehend. What I want you to think about is the actual numbers. Is going to be the key part. So let's take a look here at another example, the E-mini S&P. This is actually one that somebody sent me this week. I changed it up a little bit. I like to use one contract when I do these examples. I'll let you know my theory on trading, and this came from a guy that worked with me years ago. The way I trade, I was never a scalper. I was more a short-term to swing type trader. Um, with that, I wanted to get my risk out up front. I wasn't a swing trader because I was letting my position run against me for 3 days. So I also like to use multiple contracts because if I'm trying to manage a position, if it makes that big run, the problem with just trading one contract of anything is you have to take it off. You can manage it with trailing stops, but it can be difficult. Whereas if you can get one contract off and then manage a second or third contract, that was just my opinion. Everybody does it a bit differently. Right now, MS, you can do it with the equity index futures. We are CFTC regulated, so we don't have SEC regulated contracts. Um, so we've got, this is a chart of the S&P E-mini underlying. Now, one thing I'm going to make a point of, NADEX offers charts. We offer charts on our contracts. I would never use the chart on a NADEX contract to save my life. Let me just be perfectly blunt about that. Not that they're bad, they just don't tell me anything. The reason they don't tell me anything is because the charts are based on a very short-term contract. If I want to look at multiple time frames, it's difficult to do. Why can I glean from a chart that's 4 hours old? Not much. So when I'm doing my analysis, when I'm doing any technicals, I want to look at the actual underlying chart because that's what's going to determine the direction of the NADEX contracts, whether it be a binary or a bull spread. The one chart, I'll make an exception to that, is we do offer on the spot currencies, we do offer charts of the underlying. Those go back a ways so you can see the analysis. But if you're trading things like oil, gold, ES, any of those, find a good charting package. It's so worth it. So here we have one. This was sent in to me earlier this week. S&P E-mini underlying. And I'm actually going to blow up my screen a little bit here. And whoop, one second. Whoop, not sure what just happened there. Okay, so we had the ES. If we're looking at it, let's say we were going to go long. At this time, it was trading. I think this was Monday evening. Um, long one at 1522, right? So we believe the market's going to go up. We put in our stop. Now in this case, this guy had a stop. He was actually trading 3 contracts. I'm going to just use one to keep the math easier. So he had one long, 1522, a stop at 1512, which is a pretty healthy stop, 10 points on the ES, $50 per point, so it's a $500 stop on one contract. The risk is $500, right? If we've got 50 points per contract per point times 10, very easy to figure out 500. What we can do though now is use this bull spread. We're actually going to go short the bull spread. I know that sounds counterintuitive. We're going short again because we're long on the underlying. When we're long the underlying, we want to hedge that. We want to take the risk out. So let's take a look at what happens to our risk. Now in this case, the actual market was trading over the ceiling. The actual range of the spread was 1480 to 1520. So the market was actually over that. Now when the market's over the top of the spread, I pay a little bit less optionality. So I can trade closer to the top. I'll never be able to execute a trade right at the top on a short or right at the bottom for a long, really because nobody in their right mind is going to, if I'm trying to sell, they're going to buy that particular one In this case, this was I believe this was an 8 hour or no, this was the daily spread. This was the daily 40 point spread. Got into it, thinking the market's going to go up. So now what I've got though, I'm going to do short five spreads. Five spreads. The reason I do five is because NADEX, there's basically 10 ticks per point on the US 500, which is based on the ES. I'm going to do five of those to make it equal to $50 per point. Right? So I'm long one on the ES at $50 per point. I want to be short five to make it $50 per point short. If three contracts, um, then I'd want to do 15 spreads. The floors are preset by the exchange, and there's multiple ranges every day. It's actually based on where the market's trading. Like for instance, we might have a spread that right now we've got the one from 1520 to 1480. There's probably another one from 1520 up to 1560 because it encapsulates the market. And they're all based on basically the range of the underlying market. Great question, Rosemary. The margin per contract is based on your risk. It's actually collateral. So in this case, in order for me to put on the short five spreads at 1519, I've got $50 risk. It's basically at 1519, I have 1 point to the ceiling at 1520. So on that particular contract, if I was just doing it by that, it'd be $50. So I could put that on for $50 in collateral. It doesn't matter if the market shoots up to 1600, I can still only lose that 50 bucks. If I was, to give another example, if I was actually short five spreads at like 1517, I'd actually be $150 risk, $50 per point because I did five contracts. And actually, Ron, I'm not naked at all because this is a spread. Um, the risk is always limited. Unlike if I was selling, let's say I was selling a call or a put where I'd have virtually unlimited risk depending on the side. I'm not naked at all ever on a NADEX contract. I've always got limited risk as well as limited reward. So in this case, I'm short five spreads. Now look what happens. Our risk when we were just trading the underlying was $500. By adding in the spread, we can move our stop from where it was at down to 1512 all the way down to the floor at 1580. Volatility will impact the price um, of the actual option. These are so short term, we don't run into a lot of time as far as that value, but the volatility will impact the price. So if volatility was really up, instead of be able to go short five spreads, I might have to go short at, maybe 1518.50 or 1518. In this case, though, now what happened? I was just able to move my stop from 1512 in the underlying all the way down to 1480. That, if my math is correct, is a 42-point stop. At $50 a contract, what is that, 2,100 bucks per contract? That's a big stop. The floor and ceiling will be published along with it. So when they're made, basically what you'd see on this contract is you'd see, if we take a look at this one, you'd see US 500 March, which is the March underlying contract of the E-mini, 1480 to 1520. So you'll see the range. It'll be right on the order ticket. And again, I definitely encourage everybody to do the demo account. But basically what I've done now is I've taken a stop. Remember Casey talked about safe stops, tight stops? I know with tight stops I got stopped out a lot. With farther stops I took too much risk. Well, actually, Wang, the leverage question, there's really not a great deal of actual leverage in the contract, and it'll depend on where you trade it. But there's a great deal of what I call effective leverage, right? Because in this case, it's a $400 contract. So if I paid $50 to get into that, what is that? 8 to 1 is the only leverage. But when I compare it to what it would take in the underlying, I can trade the equivalent of one E-mini S&P for 50 bucks or 100 bucks or 200 bucks. You can never get assigned anything. There's no fungibility with the other markets. It is strictly a position, and it's all cash settled. And so what I've done now is now in the underlying market, I'm protected down to the floor of 1480. We'll take a look at that. That's actually the scenario we're going to do right now, Richard. Effectively, I have a 42-point stop, but my risk, instead of being the initial one on a 10-point stop of 500, by combining it with the bull spread, my risk with the 42-point stop on this position is 150 bucks instead of 500. So I've actually moved my stop 32 points farther away, but cut my risk down by what, 70% roughly? 75%? To me, that's pretty cool. So what would happen is if the market does this, and actually, Rick, I'll run through those scenarios right now. So the market dropped down, and we saw this. This was actually the action on Tuesday. Dropped down, had a big move. Had a big move. We'd easily been stopped out and lost 500 on the 1410. In this case, that position that would have cost us $500, now actually our worst case scenario is basically the market dropping to 1519. That's our break even on the spread, or 1520. The math works out the same. We lose $50 per point at either 1519 or 1520. The reason I say either way, because if it goes to 1520, we've lost 50 on the spread and 100 on the actual underlying position with one contract. In this case, though, now instead of losing 500 or being stopped out, we can still maybe be in the trade because we never got stopped out. Our spread is expired, maybe around the 1490 range. If that's the case, instead of losing that 500 bucks, we've lost 150. We've basically bought insurance to limit our losses, which is kind of really the key to trading. To the premium buying a protective option on the Forex futures contract. I've never really traded the Forex futures contract on the option side. I used to trade spot Forex options, and it's going to be a little bit different. It's still going to be based roughly on the same things. Where it's going to be different is you've got the ranges set, and there's not as much time. Because if you buy an option that maybe is out 2 weeks or 3 weeks, you actually get some time premium built in there, particularly in Forex, where you're doing an implied volatility for the life of that. Because these are so short term, there's not a lot of time, and so the volatility can actually be very much more easily managed. Is the 1480 level your target for the sell? My 1480, yes. The reason I would set my stop at 1480, and I might even put it a little bit ahead of the floor, just because I'm going to have some optionality on the floor. The reason I do that is because that's where I'm protected down to. It keeps me from getting whipsawed out. My ideal scenario, and let me just run through them here. The market drops down to 1480, I get stopped out, that's where my contract expires. The market drops from 1522 to 1480. In this scenario, I've lost 150 bucks. So the ES went against me 42 points on one contract, and I've only lost 150 bucks. If the market drops to 1519 or 1520, and I get out of both, that's my worst case scenario. I've lost 150 bucks. I've lost 3 points. If the market moves up, the protection of my spread stops at the ceiling of 1520. So let's say the market moves up, instead of dropping 20 points, moves up 20 points. So it moves from 1522 to 1542. So I've made 50 bucks per point on 20 ticks. That's $1,000. I've made $1,000 on my underlying contract. I've lost 100 on my spread because if it settles over 1520, I'm going to lose, or excuse me, I've lost $50 on my spread because I've got 5 contracts. In that case, I've made 1,000 on my underlying. I've lost 50 plus $4.50, by the way, for the exchange fee. So I've actually lost $54.50 on and made basically a net of $945.50. So there's all the different scenarios. If it's under 1480 at expiration, and that's why you want to keep your stop there, who cares? Hopefully you got stopped out. Now you're only protected to 1480. If for some reason the S&P gapped from 1522 to 1460, well, you'd actually be responsible because you were only protected down to 1480 for those 20. I've personally never seen the S&P gap anywhere near that. I have though. If anybody remembers, well, I should take that back. Anybody remember the flash crash? I'm being silly because that was only a couple years ago. Um, we did see some big gaps that day. Kind of an anomaly, and yeah, William, black swan, it can happen. But let's say you were trading the ES straight up at 1522 and it gapped to 1460, then you'd be on the hook for all of those. At least by implementing this, you've protected yourself for 40 of those. I remember I was trading coach working with a bunch of people March of 2009, trading the currencies. Well, what happened? The Fed came out, introduced this thing that we all know so well as quantitative easing, and we saw the major currency pairs gap 170, 180 pips. So 1,800 bucks a contract in the gap alone. Somebody trading with a 30 pip stop, guess what? It's not stopped at 30. It's the best available. It's 180. So they lost 150 pips more than they thought. They could have been protected on a spread. The one difference, William, on the selling puts is, well, and it depends on the scenarios you're using. It depends on what your underlying is. I would never just sell naked puts. I wouldn't sell naked. Uh, Steve, could gap on Sunday night with the U.S. sequester. NADEX hours, it's closer to the 24 hours, and actually we're going to be increasing the ranges a little bit. I'll cover that in just a little bit more. And I want to go through another example because we were talking about it. The short term to swing, because these are short term contracts. A lot of people say, well, Dan, I'm a swing trader. I can't use a short term contract. What I want to do is stick with the theme of risk, though. Because anytime you're placing a trade, right, we're not swing traders because we let the market go against us 3 days. We're not swing traders because we lose $2,000 in a move to make 4,000 hopefully. One of the greatest things ever said to me when I first started trading was this guy who'd been trading about 30 years at that point, and he said the only difference between him and people that were just starting out was that he got out of his losers faster, right? If it was going against him, he got out. I've heard a lot of people say, well, I'm a swing trader in Forex, and that's great. I also know that statistically, on average, the Forex trade lasts about an hour and 20 minutes. Now, that was just a study I did a few years ago. It maybe changes a little bit. But I've unfortunately seen a lot of people that say, I'm not going to put a stop in, or I'm going to put my stop so far away because I'm a swing trader, just so that it goes against them for 2 days, and then all of a sudden it makes a break in their favor and they close out the trade. Oh, hey, I was profitable. I was right. Look at my win percentage. It has nothing to do with that. It has to do with risk and managing that risk, whether you're short term or longer term. Okay, so we're going to take a look. This was if I was just trading the underlying. This is the Euro USD. And this is just an example. I mentioned scaling a little bit earlier. This is just an example um, of a potential setup on a trade. So let's say I think the market's going to go down. And we're just going to do a comparison. And this is really, I think, one of the powerful things about options in general is the ability to get a high degree of effective leverage with potentially less risk. So, yeah, exactly, Tom. It's what is the old saying from Amos Hofstadter? Take care of your losses, and the profits take care of themselves. Some of the truest words in all of trading. So let's take a look at this. So this is just an underlying. So let's say I was going to sell 3 contracts of the Euro USD at 140.20. 3 contracts. I've got to decide where to put my stop. So, as an example, we put it up here. That's my risk. Depending on what that is. Everybody, might do their stops a little bit differently. I personally use patterns and fib ratios. Actually, after working with Tom O'Brien for quite a bit now, I've been using a lot more volume studies because I'm not allowed to trade the futures anymore, but I can get my volume in the equities because they're SEC regulated, not CFTC. In this case, this is just a simple example of scaling out and managing the trade. So we get in, we're short 3 Euro USD. Ooh, almost stops us out, but then moves in our favor. So move down to 139.10. That was our first profit target. So that profit's taken out. We've now got 2 contracts of the Euro USD left on. We hit our first profit target. Maybe we move our stop to break even. Market makes another move, and Bam, we're having a great day. Our next limit got taken out. And then we move our stop down and maybe we continue manually trailing that stop. Maybe we set it automatic, whatever the case may be, however we're going to manage that. So we've had a really excellent trade. But it's never about one trade, is it? It's always about the probabilities, and it's not about one trade, 5 trade, 10 trades. It's about what happens over the course of time. What happens over 500 trades, or 1,000 trades, or 2,000 trades? Um, yes, all the major the question is, are NADEX contracts available for yen, pound, all the major currencies as well as some yen crosses, and we're looking at adding a couple more yen crosses as well. But euro yen, pound yen, and then all the majors. Let's see, Jerome. From a tax perspective, Jerome, they're treated as futures contracts. I don't know the jurisdiction you're in. I can't really answer any tax contracts, or excuse me, tax questions on the contracts. Treated like futures, but talk to an accountant whenever you're filing them. They're 1099 for U.S. residents at the end of the year. And so here we had the 3 euro USD. We had a great trade, no question about it. Let's take a look at that scenario. Again, all of our risk was up front, right? Because it's that first couple hours of the trade that make it or break it. If it's going against us, we don't want to sit on it for 3 days. We want to get the heck out. If it's going in our favor, we want to maximize our returns. So let's take a look, and I'll show the whole scenario. Here we've got a bull spread. Um, in this case, before we sold at 140.20, the market is actually over. And let me get my little drawing tools out here. The market is actually over. If you can see where my cursor is, the market is actually over the ceiling. But that's all right. Um, we've got you know time basically here. We can still trade. This contract is still active because it's over the ceiling here, or if it was under the floor, I can sell pretty close to the ceiling. I can really limit my risk. In this case, okay, I'm looking at this spread. This spread was a 250 pip spread. I'm selling 30 euro USD. Again, the reason I'm selling 30 is because I was doing 3 in the underlying. I want to do a per point equivalent. So if I do 30 euro USDs, that's $30 per pip. I'm going to set up essentially the same profit targets. I'm going to obviously make them in quantities. So we've got sold 30 instead of 3 to do the per point equivalent. Instead of buying back 1 in the underlying, we're buying back 10. And in this case, we're going to buy back 20. Um, as far as the time constraints, these are daily and intraday. So there are multiple contracts made all the time. There are different strategies you can do with these. We'll probably do some more of these. I've got quite a few strategies that I've worked on over the years. So we've got this. So the same scenario happens, right? Market starts out against us and then moves in our favor. And I've got just about 7 minutes left, so I'm going to try to get all the questions. I'm just going to run through this scenario quick. Same market action. I haven't changed a thing. The market does what it's going to do. So now we've bought back 10 contracts at the same first profit target, 139.10. Market does the same thing, and now we've bought 20 back. So now our full spread position is closed. Now we go into the underlying market and we sell the Euro USD at 138.10. What this does for us, now, because we're time constrained by this option contract, it went in our favor. We took out our front side risk. It went in our favor. Now, instead of getting in at the top at 140.20 and having all that risk up front, now we sell one at 138.10 and maybe we've got to stop at 138.50 or 138.60 or wherever we put it, but we've already made money on the trade. So we sell one and now it can run forever. So we're doing a combination. We're taking out the upfront risk. We're using a short-term contract to see if it goes in our favor and also take out the possibility of just getting whipsawed out or shaken out, um, as Casey had said earlier. So we take out that front side risk. We take out a stop um, coming up and just hitting our just basically a spike hitting our stop and taking us out just to watch the market go in our favor. We've eliminated those two things, and now if it runs in our favor, great. Now we can get into the underlying market, run it, manage it as long as we like. I want to do a quick breakdown here in the underlying, in these two trades. So in that example, and I'll just bring them both up here. in that example, in the underlying market, we sold 3 at 140.20. We took our first profit at 139.10 for 110 pips, our second at 138.10 for 190 pips on that contract. So still having one contract on, we had an awesome trade, 300 pips, 3,000 bucks. I think any of us would take that any day or even over a course of days or course of trades. Now, on the spread, we did effectively the same thing. We sold 30. We sold it a little bit lower because we had that floor and ceiling, right? We had the ceiling at basically 140. So we sold some pips. Maybe, depending on the volatility, maybe we sell it at 139.90 or 139.80. In this case, we sold at 139.95, took our first profit at 139.10. So we got 85. So we missed out on about 25 pips there. Second profit, we hit at 138.10. That's where we went in and basically would have sold the underlying. So the spread versus the actual underlying, we made 3,000 in the underlying. We made 2,700 on the spread. Now, a lot of people might look at that and go, well, geez, I made more money in the underlying. Why wouldn't I just do that? And the reason, again, when we not talk about one trade, but when we talk about multiple trades, let's show how the numbers really work out. So on this case, let's say we're risking 80 pips. Our risk on the underlying was 2,400 bucks. Actually, margin I think would have been over 6,000. At 140, be 2,800 a contract. So we'd actually be looking at much more margin than 6,000. Risk-reward ratio of 1.5 to 1 in this particular case. Return on margin was 50%. In the case of the spread, risk was $5 per contract times 30 contracts, $150. Instead of putting up over 6,000, we put up 150 bucks. As that moves, you'll see what's as far as as far as your profit and loss as well. Risk-reward ratio of 18 to 1 by doing that. Return on margin 1,800%. So basically what I'm saying is here, I made a little bit less on this one particular instance. But let's say I was 50-50. What if, I lost 2,400 on one and then made 3,000, I'm up 600 bucks. On the spread, what if I lost 150 on one and made 2,700 on the other? Right? It makes a big difference over the course of trading. I don't think Thinkorswim has a binary option, although you can definitely call Tom and encourage him because as one of the things we're going to talk about, we've developed some technology that we're going to talk about solutions for additional brokers to come on board, which allow for international trading. If any of you have, particularly you in the international community, if there's anybody U.S. broker that you're using, you'd like this interests you, go ahead and give your broker a shout. That's one of the best ways to get the word out. One of the other things I want to show here is, what if, because this is a short-term contract, right? What happens if the market doesn't move in our favor? We don't make any money. Well, in this case, we didn't make anything we didn't make anything on the underlying, and we lost 150 bucks. Here's the thing: I could do this spread trade 16 times in a row, lose every time, and if it works out once, I've actually made my money. With the actual spread contract, the time frames are typically daily and intraday. I've looked at doing them out for a week. The problem is, as you get out to a week in these particular things, the pricing starts to get skewed a little bit by more time. It's much harder from a volatility perspective because you're implying that volatility out over time. You've got the time factor, and so the pricing doesn't look as attractive. Also, because the market can make such big moves, I want to be able to, if it moves in my favor right away, on a short term, I'm just looking to protect myself or get in and have the market move in my favor. If it doesn't move in my favor in the first 4 or 5 hours, I've got to believe then my analysis was probably incorrect. Now, maybe it will once I close that trade, but I don't want to hang around and wait for that. And so what I like to do is if it's going to run, if I think it's going to go in my favor for a week, I'd get in on the spread on the open of it. Maybe it runs in my favor for the first 4 hours. And then, I close out the spread, I get into the underlying, and now I have a stop that's already in profit from an overall presentation. Why not a straddle? Mike, do a straddle. You can take both sides of it because there's multiple ranges. So you can typically find a common floor or ceiling. So you can straddle the market. Particularly where I wouldn't trade Forex in front of a Fed announcement, I might straddle a spread because I'm expecting a big move. It's direction neutral. I just don't know which it's going to be. Rick, there's market makers on NADEX as well as other members. Every member is a market maker because um, you don't have to take what's being bid or offered. You can actually split the bid offer. I'm just about running out of time. And Morgan, if I can take one more second, I just want to mention to everybody. Morgan put up a link. You can go to nadex.com. I think he's got a link to apply for a demo. The demos are 2 weeks. We can extend it for a couple weeks. One of the things that I encourage everybody to do is take the time. So as part of that, like every other futures platform, if you open a live account and fund it, you don't have to trade it. There's no inactivity fees. But if you open up a live account and fund it, um, shoot me an email. I'll put up my email here. I'll extend your demo for a year. If you take a look at it for a month or 2 months and then decide, hey, I'm never trading this, this isn't for me, take your money back out. The only requirement is that you have a funded live account, and I'll extend your demo basically as long as you want it. I can only do it a year at a time because that's the restraint on my system, but if you call me up a year from now, I'll definitely do that. So if you have a live, if you open a live funded account or do open one, I'm going to put up my email address here. I will say we've got a big crowd on here. Um, oh yeah, the minimum funding is $100, so it's very low, low from a funding requirement. I will